knowing the ratio between gold and silver also allows you to actually increase your stack of gold or silver without needing to buy any.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi there, my name is Shane Moran and I'll be your host for this week's episode of Live from the Vault. And as you can see, I'm in beautiful South Italy and it's a beautiful sunny day here. So welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times we're living in right now. With exclusive access we have to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Now, this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the house. And to help him pull back the curtain this week, we'll be joined by popular demand from you, our Live from the Vault community industry experts, Kevin Wadsworth and Patrick Karim of Northstar Badcharts. They're in the house, and that's right, Kevin and Patrick are in the house, and you're not going to want to miss this conversation for sure because we have a special announcement. All right, so just before we get started here, please help us spread the word about this channel by hitting that like button, share this information, and be sure to subscribe if you haven't already done so. And click on that bell right there if you want to be notified as each episode goes live. So with that, let me tell you a little bit about Kevin Wadsworth and Patrick Karim of Northstar Badcharts. They're both enthusiastic supporters, as you're about to hear, of the Kinesis monetary system. They launched Northstar Badcharts back in May of 2021, and their site is a culmination of collaborative work between Northstar, which is Kevin Wadsworth, and Badcharts, which is Patrick Karim. That's where the Northstar Badcharts comes from. And they have more than 30 years in combined chart trading experience. So these are not two gentlemen that just got started here. They've been doing this for a long time, and you're going to love that. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guests, Kevin Wadsworth and Patrick Karim of Northstar Badcharts. Over to you, Andy.
Yeah, this is a real buzz for me. A really amazing team. I know Kevin and Patrick's skill sets are fantastic, and this is going to be a real treasure for our Live from the Vault viewers. And I'm looking at both of you here. So Kevin, look, I know that you, for example, spent 30 years as a professional meteorologist. And I think we just spoke briefly a minute ago that you also followed the work of Alan Andrews, and I think that was back in the 19th early century. I'm not saying you were around then, and no, I'm not saying I'm that old either. But I started first studying his work for some years ago, and because he had this uncanny knack of predicting and charting the weather. And I thought, well, if someone can do that, bloody hell, pretty much you can do anything. And so a long story short, his amazingly accurate charting methods were refined by, I know Roger Babson at the time, and who he then developed the Andrews he could have evolved his system into the Andrews pitchfork technology, which I know you guys also use. And Babson was interesting because he used this charting technology in the financial markets. He actually named the exact day that the Wall Street crash of 29, and I think within 3 hours of his prediction, what was a bull market. Everyone is saying you're crazy to it. I mean, talk about parallels. I mean, everyone's racing in, and he said no, and he had for all the reasons. Now this chart, and I think what I'm trying to get to here, and I know that that you also, Patrick, are very involved with this side of this science and this charting analysis that. You obviously, when you kind of evolve these things together and something comes out. But I mean, this is incredible stuff because it can give us an indication that a perspective that cannot be got anywhere else. So guys, over to you. So thank you so much for joining us today.
Yeah, thanks, Andy. I'll just start by saying, thanks for the introduction. And the world of meteorology is where I come from. And as you say, I had a long career in weather forecasting for some very demanding clients, actually, particularly the Royal Air Force and emergency responders during severe weather events. And you can imagine that the level of detail that these guys require is absolute. You're talking about life and death situations where decisions are made, and there's a lot of pressure there. And I think a lot of people don't, they think of meteorology and weather forecasting as just the guy who stands up on TV and waves his arms around saying it's going to be sunshine and showers tomorrow. And people think, well, thanks for that. I could have worked that out for myself. But the real science of meteorology and climatology is incredibly complex, and it pushes the boundaries of what's actually possible in terms of predicting the future. And if you want to study the art and science of predicting the future, then meteorology is one good way to do it, because in order to do it properly, you have to track every molecule of gas between the Earth's surface and the top of the atmosphere. And if you're not doing that, and if you can't do that, then you have to accept the fact that what you're doing is just an approximation to that. But we use supercomputers, and we use technology, and we use science to develop a range of predictive tools. And what they enable us to do is to say, with a pretty high degree of certainty in most cases, what is likely to happen over the next 24 hours, 48 hours, over the next week, and then over the next month, and through the climate forecasts that we produce as well. So it's a case of coming to a probabilistic determination of what is likely to happen, while still accepting that there's a range of possible outcomes. And you always have to remember that just because something only has a 1% chance of occurring does not mean it cannot occur. I mean, how many times do surprising and unusual things happen in the world around us? A meteorite can strike in your backyard, however unlikely that might be. It might be 1 billion to 1 chance. And so, the world of predictive science is not. And if you ever hear anybody saying, this is what will happen with the price of gold, this is what will happen with the price of silver or the stock market or anything else, then you really need to switch off and stop listening to them, because they're not approaching it from a professional point of view. Any professional scientific forecaster will always talk in terms of likelihoods and probabilities. And as much as some people might think, well, that's just a cop out, you're just sort of hedging your bets and saying that this might happen and that might happen. I'm afraid in the real world, you have to deal in probabilities. And there's nothing wrong with that, because you can use that knowledge of probabilities to weigh your trades and to know when to go in with a high probability trade and when the trade has a low confidence level. And that's exactly the same in the world of meteorology. So we can use this knowledge and these techniques that transfer directly across from predictive science into the forecasting of the markets. And it does work. It does work. So yeah, there's more than something there. Charting is not astrology for men. With 34 years of experience of high pressure predictive science, I can promise you that there is a lot to it that really does help us in our trading and investing.
Fascinating stuff. So yeah, Patrick, just before we started speaking, just in particular, keying off what we were talking about we're talking about Andrew's pitchforks at some point.
Yes.
We're going back 100 years here, and yet, and it's something that I was studying and I noticed that you were using one of your tools that you used was pitchforks. Can you just share just some of the things you just talked about, because when you talked about Andrew's pitchforks, you talked about energy levels.
Yes.
Could you share that with our subscribers?
Well, this is what Kevin's also been saying. We hear that astrology for men. Well, when people say something like that, it's like a blanket argument or comment, because they haven't taken the time to understand what's happening. What Kevin and I, we're not the only chart traders out there or technical analysis. There's, like you said, over 100 years ago, the Japanese candlesticks, the Japanese were using charts for rice prices. I don't know, Kevin, in the 1800s, 1700s. I think even before that. I have to brush up on my history, but that stuff, humans have always analyzed price up, down, because essentially what we're seeing is human emotions. And human emotions is also, you could see as energy. So like you said, the crazy go-go 20s bull era, the energy going up, and we kind of saw it in the Bitcoin when it went from 10,000 all the way to 68,000. That energy, everybody gets like, it's like, oh, he got rich. And we're all hearing about these stories. And eventually that just evaporates. When your grandma bought, who's left to buy? Everybody bought, it's done. And all that energy going up, that sprinter, he's tired and he just crumbles, bam, energy goes down. And when you look at charts over and over, you see huge bases, and even with the pitchfork, you see these channels of resistance and support. And once you break through one of those channels in the pitchfork, that the bottom, the energy accumulated, once you break out, there's a release, and then you get the crowd getting in. And then that's why you have, look, he got it to perfection maybe back then, but it doesn't happen always like we try not to talk and we got the perfection, but you got a range where it's okay, look, this is where there's going to be fear of missing out. That's where we're going to be stretched for moving averages. That's when we have the laser eyes. Remember the laser eyes on the Bitcoin accounts, or when we have Peter Schiff saying $20,000 gold. We got to look at the charts and see exactly where we are in that energy release. Have we been accumulating energy like we have for the past 2-3 years in the precious metals, right? Consolidating tight. Or are we in a bull run where gold or silver has run from 20, 30, 40? It's already at 80. Because trust me, Andrew, when silver's 80, it's going to be hard to tell people guys, you should be taking profits, because we're going to be looking at triple digits, like 4 digits. It's going to be bonkers. And that's how you use TA, but you have to study it like Kevin and I do. You have to look at thousands. Like, I don't know, Kevin, I put at least 10,000 hours. I can't even count the amount of charts we've put in there. Look, this is also why we're important. If you don't want to do the work and learn about TA, look, when somebody buys a computer, Andy, they shop around, they look at Best Buy, they look at all the specs, and then they take a decision. And even that computer, it's not 100% sure they'll be happy with it, but at least they made the best decision. When your girlfriend or your wife goes at the grocery store, she looks at those the cantaloupes or the avocado, she touches it, she has a technique, she knows what to look for, because she can't open the peel and see if it's round inside, but she could get a probability that that's a good fruit. Well, that's all we do with chart trading. Look, and what saddens me is people go in the investment world, they buy stuff, and they don't even do the effort. They listen to the talking head on CNBC, tell them to buy. With their own hard-earned money, they do zero research. That's where, like Kevin and I, we do the research, analyzing price. And it's crazy how people are willing to put tons of money in something without even looking at price, analyzing price, while they'll spend countless hours analyzing before buying a $1 fruit or €1 fruit. They're going to spend more time analyzing that.
Well, there's a good example of that as well. And what Patrick's talking about is narratives and stories and what you read in the media and the headlines. And just to try and explain that in a way that people might understand, the use case and the narrative in favor of Bitcoin hasn't changed in the last, let's say, 3 years. Bitcoin still does what it did 3 years ago. It still has the same good arguments for it, and it still has the same reasons not to trust Bitcoin. Nothing fundamentally has particularly changed with Bitcoin, and yet the price fell from that sort of 69,000 level all the way down to below 20,000. It lost over 70% of its value. So the narrative and the story, is consistent, and yet the price pulled back, 75, 80%. So you have to at some point question, hang on a minute, do I really want to be in this because of the narrative? Or do I want to be in this because we've got a clear technical breakout, we've got all of the technical indicators, and we look at weight of evidence. Patrick and I don't ever just look at one chart. We look at the chart across multiple time frames. We compare its ratio to other investments to see if it's breaking out versus the S&P. Is it breaking out versus inflation? Is it breaking out versus money supply? And if it's doing all of those things and the technical chart indicators on top of that are all telling us the same thing, then we can have a high confidence that when the breakout occurs, it's a genuine breakout that's going to reach its measured move. So it's all about weight of evidence. So in that case of Bitcoin, why just sit there when the price of Bitcoin breaks its support level? Okay, so you're just as convinced in a story and just as convinced that it's going to one day be $2 million or whatever and the answer to the world's problems. Okay, that might be true. But in the meantime, why would you want to sit there and endure a 75% drawdown that takes 2 years to get back to the point where it broke down from. Instead of that, you could have recycled your profits into something that is breaking out and doing the whole process again. So it's a case of constantly looking at the ratio charts and moving from one winning horse, and then when that winning horse gets exhausted and needs to take a rest, you jump onto the next horse that's coming up that's just starting its race, and that way you can build your wealth.
It rings so true. And you're talking about 10,000 hours going into, and that's just and that's distilled down to confluences, as you say. When you study that many charts, and you probably dream about these bloody things as well, So you come up with a confluence out of 10,000 charts. There may be just one confluence, the highest probability entry or exit point. And I think that's what you guys offer here. And I think that, people can understand that. People are traders. They can understand. If only I could just have that one trade, because I have a big sign above my desk. No position is a position. And it's so important because, only it takes you some years to figure out that just because you got your mouse there, that isn't necessarily the time to take a trade.
Exactly, Andrew. And just building on that point, part of what we do, of course, is using those ratio charts that I've just talked about. And I know that our friends over at Kinesis, of course, you can buy physical gold and silver. It's digitized and all the rest of it. It's a great platform to allow people to get into precious metals. But knowing the ratio between gold and silver also allows you to actually increase your stack of gold or silver without needing to buy any. So say, for example, you've got 100 ounces of silver. By playing the ratio, you can turn that into 1,000 ounces of silver, but you don't even need to buy any more silver. And I think a lot of investors don't quite grasp that idea. You could hold your silver for the next 20 years and you'd still have 100 ounces of silver. Well, why not play the gold-silver ratio and turn that 100 ounces into 1,000 ounces? Because you can do that regardless of whether gold or silver is going up or down in price. So even during a bear market, you can hold the one that is more favorable, and that's, of course, usually gold in a bear market, tends to hold its value better, so that when the time comes to go back into silver, you've built up your gold position, so you're swapping it for more ounces of silver. And so the process goes on month after month, year after year. You can actually increase the stack. Yeah.
Would you be able to share, at 83 to 1, I think we've got everyone's attention here. Could you be able to share a chart maybe? And because I know this is a big push that you're coming on with, obviously with Kinesis, we're working with you and you're providing services here. And this is a great thing for people to look at. So it would be great if you could just share maybe a chart on that ratio.
So look, ratio charts, essentially, if you want to own, let's say you do want to hold precious metals, right? It's like you want to hold precious metals. You don't want to sell them for fiat. You want to hold precious metals. Well, like Kevin said, using the ratios, you're able to swap your gold for silver as silver's outperforming gold. And once silver, because of the charts, will get signals. Once silver starts outperforming, turning over versus gold, then you swap back. So essentially, you're not even touching fiat. You're not even injecting fiat, buying new ounces. But because you're swapping where silver's worth more than gold or gold is worth more than silver, you're actually getting more ounces of what you want to keep. So that's very important to bear in mind. Ratio charts, they're very good as long as it's something that you want to hold both. Because you gotta think also the price of gold and silver can be going down and you could still increase your stack. And Kevin's gonna showcase that in bear markets. If you're able to swap into the best performing of the gold or silver, even on the way down, when both are losing price, when you swap at the bottom, you actually increase your ounces.
Okay, so this is the gold-silver ratio chart, and it kind of showcases what is possible using the techniques that we employ over at the website there. So, for example, starting with an ounce of gold, which at the time was approximately worth 50 ounces of silver back in 1982, by selling the breakdowns and buying the breakouts. And there's a number of confirming techniques that we use to confirm when the breakdown occurs and when the breakout occurs, or when the support level is hit for the ratio chart. So when is a good time to swap back into silver or back into gold? But you can see that by swapping your 1 ounce of gold and converting it to silver here, and then converting it back, you've already started to increase your stack from 1 ounce of gold to 1.6 ounces of gold. And that's just because the ratio has altered your relationship between gold ounces and silver ounces has altered. And then during this period from during the 1980s, of course, the gold market wasn't really doing anything particularly exciting, but you're still able to increase your silver now to 107 ounces of silver from the original 49.9 ounces or 50 ounces. So you've sort of doubled your stack of silver there in a 5-year period during a time when most people involved in precious metals were managing to probably lose money very, very nicely. So your stack's increasing despite a particularly poor time for precious metals. And of course, that poor time in precious metals continued through the 1990s there. And of course, we didn't have the big bull run until roughly the year 2000, 2001. So during this entire period where precious metals were struggling, you can see the ounces increasing 187 ounces of silver. We're up to 3.8 ounces of gold here from our 1 ounce of gold. Then we swap back again, 245 ounces of silver. Then we swap back again and back again, 325 ounces of silver. And then when the bull market really starts going, you can really start to make some big gains in your stack here. And you see quite quickly going from 325 to 500 ounces, 500 ounces to over 1,000 ounces. And our most recent swaps occurred April 30th, 2021. And then this one here on August 31st of 2022. And during that particular swap, we went from 812 ounces of silver to 1,123 ounces of silver. So this continues to be tracked. You can see the resistance line. You can see the support level. We consider moving averages and other technical indicators as well to guide us. But for the time being, whilst we're below this wake-up line here and the 12-month moving average, silver is the metal that is favoured. So the story continues, and so the journey continues with the gold-silver ratio tracker. So that's how you can increase your stack, even if the price is going down.
Presumably, when looking at that chart, you've really you to keep it sort of understandable, you've removed so many of the formulas and energies that levels that were required to actually come up with those supply and resistance lines. So
exactly, I know people will be thinking, oh well, that looks great on the chart, and you can draw little circles there where you swap from one to the other. But the idea of the website is to take a lot of that technical science out of it, because I know people struggle to interpret and struggle. Listen, Andrew, as a meteorologist, there's one thing that I learned. I'll tell you a little story. One thing that I learned: it's one thing to have great information and a weather forecast that is 100% accurate. It is a different thing entirely to be able to convey that to someone so that they can understand it. Classic example, Met Office produces weather forecasts, gives them to fast jet pilots in the form of very complex charts. Now, these guys are highly educated, highly trained. They're flying, very fast, high-tech, jet aircraft at low levels, high levels, flying sorties all over the UK and all over the world. So, these guys are highly intelligent. But after a briefing one day, which has to be kept to 3 minutes, I asked them, did you actually understand that chart? Were you able to take the information in? And these guys, as clever as they weren't able to repeat back to me the information that I was trying to get across to them. So I simplified the information, made a very simple chart out of it, effectively just using 3 colors: green for go, amber for marginal, and red for no-go. And then just by using that chart and colouring the UK in 3 colours, I could show them whether their mission was a go or a no-go. And that, at the end of the day, that's all they want to know. And traders and investors, they want to know, can I get into this trade and do I need to exit it? All of the science and all of the background work that's done, it's great, it's interesting, but I can guarantee you 99% of people out there, they just want the answer. They don't want to know all of the work that goes behind it. Having said that, of course, on our website, we do explain all of that. It's not some kind of it's not a dark art that we keep to ourselves. We try to educate and train and provide training, and we want our followers and members to learn to do this for themselves if that's what they want to do.
It's such a specialized field that you're in. And I think I always figure you leave to the specialist what is your field. And I think, as you say, distilling something like that, you get an example there, which could be obviously used for trades, everyday trades, where you've distilled a vast amount of information using if you put that on a chart, it would be deer in the headlights for most people. I mean, what do you react to? And to distill that down is really what you bring to the table. And I think your history says, take note, guys, because these guys know what they're talking about. And I think, it doesn't come easily. And as you say, you've got your background and Patrick's got his background there as well. And I think you work so well together. And it's interesting. So tell us what you're seeing, tell us what you're seeing now that's interesting, particularly interesting.
Well, I have some, I could show you a chart, guys. Look, this is the question we always get. When is silver going to break out? Patrick, you got to tell me, when's silver going to break out? How come silver's not at all-time highs back in the 80s? How come silver's not back at all-time highs in 2011? Well, this is it. Silver, so the alpha is gold. Gold, it's weird, Andrew, because just before this call, I was telling Kevin, look, there's no other chart that looks like the gold chart. It's its own asset class. It tracks inversely the US dollar divided by CPI, or it tracks destruction of purchasing power or purchasing power. Gold's the alpha. Silver is the beta, the baby brother of gold. Gold divided by CPI is what silver tracks. So this is a chart with a lot more details, but again, often I dump it on Twitter and people don't get the nuances. It's complex. So on our website, all these type of details, like we explain everything that are through written commentary or podcast. We explain everything to our members. Look how silver tracks the gold divided by CPI. It's like that. If you want to know what's going to happen to the silver price, you want CPI to go up, but you want gold to go up, but you want gold to go up faster than CPI. So gold outperforms CPI is what really drives silver, and silver has to price in that incoming inflation that gold is pricing ahead. Because remember, gold's probably going to peak 6 months, 8 months before the CPI print hits all-time high, even a year probably. Remember, gold peaked in August, I think, of 2020, and the CPI kept going up and up and up. And people think, how come gold's not going up? Gold knows all. It prices ahead of time. It sees what's happening. So this is critical. Look at the bottom. I have a little bit technical. Guys who love the MACD, you see that you have a single, a bullish, almost a bullish cross for silver, for gold versus CPI, about to look like 2019, about to look like 2002. Here we had one false signal, 1986. It looks like maybe the 70s. So if people are wondering why silver's not breaking out, it's waiting for gold to outpace inflation. And look, today, I don't know when this is going to be released, but silver's going bonkers today. Gold is probably going to, if I look at, update that chart, we'll probably see gold trying to break out versus CPI.
Yeah, we're recording this on the 12th, just so people know we're recording this on the 12th, yeah.
It's all about coiled and tight, and we're not stretched. We've had over 2 years of consolidation, guys. People don't realize that's 2 years of your life. It's like people, 2 years. No, 2 years is a long time for the price to go sideways and get really, really tight. So when you get that confirmed breakout, and people could subscribe to email notifications on our website so they won't miss any of these signals. Man, these opportunities, they don't come back often, very, very often, Andrew, there. So you got to really pay attention to the price signals, what they're giving you.
I think one of the other things I found fascinating, and I must say, I do follow you, is I think you generated a bit of a two-way conversation regarding people who think that gold can't rise alongside the dollar, and I'm going to ask you to explain that a little more about that. But I mean, goodness me, yeah, we know that. I mean, like, look what happened in 2008. I mean, gold rose for 3 solid years, from $680 to $1,200 without any pullbacks, basically, with a rising dollar. So it's interesting. So, and then a lot of people looked like weren't getting that. So maybe you can explain a little bit about that.
I think both myself and Patrick have put out charts that sort of dispel that myth that gold and the US dollar can't rise together. There are many times in the recent past where that just has been proven to be completely wrong. And in fact, I put a tweet out myself I think it was yesterday or the day before yesterday, I think it was, that shows very clearly The US dollar index was 69 back in 2008, 2009. Gold at the time was around about $800 at the time, or even less. Now, the DXY, although it's risen from 69 to well over 100, gold, guess what gold's done? Well, gold's moved from $800 to nearly $2,000. And that's it over the entire period from 2008 to now. So if you look at that chart, it just rises from bottom left to top right for the gold price. And it also does for the US dollar index as well. So taken as a whole, both have risen together. Now, yes, when you look at very short time frames on a daily or an hourly basis, then, an upwards tick in DXY can cause a downwards tick in the gold price. But when you zoom out and stretch that out over weeks and months and years, what you're really looking at there is just a tiny ripple that is making no difference whatsoever to the huge wave that is taking place. There you go. There's that chart there, bottom left to top right for the gold price and the US dollar index. Of course, the US dollar index, you have to stop a second and think, what is the US dollar index? It's just the US dollar essentially versus the euro, because the euro is the major part of the US dollar index that is measuring strength and weakness of the US dollar. Also contains the British pound and the Japanese yen and Canadian dollar, I think, and one or two others. But principally, it's the USD euro pair. So that fluctuation of the US dollar index, you're just comparing deflating fiat currencies, which is not really what. It's not a good measuring tool, to be fair.
And it's understandable. It's understandable because when you think that both gold and foreign exchange markets, gold and silver, trade as a foreign exchange cross. So you're long dollar, short gold, long gold, short dollar. So it's understandable, and especially it's understandable that people think, well, tick for tick for tick. But as you say, there's wheels within wheels. And of course, there are times when that completely dislocates. And I think it's interesting that you can come up with, when you track those kind of situations, another confluence, maybe another input where you think, right, I've been waiting to get in, maybe on a dip or a buy stop or something like that. And for looking for those inputs. So it's very, very useful to have that information. And so because it's easy to make that mistake where they're just directly correlated because they're an FX cross. So interesting.
Always question narratives. Whatever narrative you're faced with, whatever someone comments on Twitter and someone says, "Oh, this is the case," X means Y. Then, if you haven't got the evidence to prove that and support it, then don't believe it. So, as technical chart traders, whenever someone says something or makes a statement, my first reaction is to go straight to my chart and look for the proof. I'm a scientist myself, so I don't accept anything at face value. Whatever someone tells me, I have to look at the chart. It's my instant reaction. Look at the chart, find the evidence, and if what they're saying isn't true, show that person, well, look, this just isn't the case, and here's the proof that it isn't the case, because it helps to dispel those myths, and it helps to, for people who are still learning, as we all are in this journey. It's all about sharing that knowledge, and I try not to get cross that someone is putting misinformation out there, because it's not necessarily their fault. They're just repeating something that they've heard. But trying to right that miscomprehension is something I really want to try and do.
If everything was a level playing field, life would be simple, isn't it? But you've got, especially in the gold world, where we have a massive paper market, which is non-NSFR compliant in the COMEX, whereas on the 1st of January, we had Basel III NSFR conditions kick in. So if you're a liquidity provider and you're providing foreign exchange gold, you better have that physical to deliver. So that's a complete change. So it's an input change, which I think is important when people just look back and they look at, history says it'll do this, it'll do that. No, it isn't, because we see inputs change all the time. And you talk about that one meteorite. Well, actually, the meteorite landed about 5 doors away about last year. But essentially, these inputs are important to track, because people just think it's so simple, but it's not. And you've got this unwind of paper market liquidity now flowing into a much more deliverable market, which is not circling around the same ring fence where it used to circle around. So I think it's important that people realize there are things that you need to change, things that inputs you need to have to put in.
That's a great point, because that's why I tell everybody when somebody has they studied one fundamental metric and they think that's driving up the price or down. But then if you're not a specialist in fundamental research and you're not on track of everything, the plethora of fundamental levers that move, that impact the price, then you're dead man walking, because that one thing that you didn't account for, man, I forgot to think about that. Of course, the price gonna, So all that, as chart traders, you're gonna analyze you're gonna analyze what you think is gonna move the price. You're gonna wager your money. That other fund manager, he's managing billions. He has his own plethora of analysts. They're going to tell him, okay, we want to go long, short. All these people across the world, you know what? We're going to see in the chart as an aggregate. So whatever the reasons are, we're waiting for all the market participants to place their bets. And when we see that there's some type of breakout in that energy, so if we could circle back to Andrew, there's energy buildup that explodes. Us as chart traders, whatever the reason, we're saying, okay, that's a low risk, high probability trade. We're going to play that, because I know nothing. I'm not a fundamental specialist. I can't run around and read all these articles. So me and Kevin, we're chart specialists. We accept that we don't know anything or everything. We wait for all the specialists to place their bets, and we analyze the end result of that.
Fantastic view. Yeah, so this is really interesting stuff, and I think this is why people should follow you. And now you're doing a lot of work with Kinesis. Very proud to have you guys, working with our group. So what are you actually working on at the moment with us?
I mean, yeah, basically what we're providing and what we're doing is that we are allowing Kinesis users, Kinesis customers around the world to have access to our services for obviously a huge discount as part of our link up with Kinesis, as you say, and that has allowed us to develop a particular service for those users of Kinesis. I mean, I use Kinesis myself, and I swap between gold and silver and cryptocurrencies. And one thing that's very impressive with the system is just how quick and how relatively cheap it is as well to make that switch. You can sell your silver, sell your gold with a click of a button, convert it into the currency of your choice, and then buy, whether it's cryptocurrencies or you're wanting to swap it from silver to gold. So you're allowed to take, or you're able to take advantage of that that ratio chart that I was talking about. And that's not the only ratio chart that we have for Kinesis users on the website, of course. We have other ratio charts that, as I say, allow you to take advantage of, for example, the Bitcoin to Ethereum ratio, and always be aware of which one of those pairs is outperforming the other. Because, of course, as an investor or trader, you always want to be on the winning horse. Why be on, why be in the trade that's going to go up maybe 100% when you can be in the instrument that's going to go up 150%? So those ratio charts allow us to track the relative performance of one instrument versus another. So that's the service that, as I say, we've developed specifically for and uniquely for Kinesis users.
I saw you actually walk people through you showed them inside your Kinesis platform, and what you were doing was suggesting that you could actually, with a click of a mouse, you could use that ratio trade. You could move out of silver into gold and gold back into silver with a click of a mouse without actually going out the market. And I think that was, to me, I thought, wow, that is a really cool idea.
Well, yeah, I mean, it's one thing for us to have the Kinesis logo on the chart and for us to suggest to people that this is a platform that you might want to consider. But I use it myself, and quite rightly, people have asked me, Kevin, can you show us how to use the Kinesis network? I know that the Kinesis platform and on the Kinesis website, there's a whole load of explainer videos, and they're very good and they're great. And I try and direct people to to those explainer videos. But sometimes, because people, I suppose, know me and Patrick, and they trust us and whatever, they like our style or the way I explain things, whatever. And they sort of ask me, Kevin, can you just quickly show yourself, doing a trade on the platform? And of course, I'm quite happy to oblige with that. It just takes a matter of seconds. You just log in, couple of mouse clicks, and hey presto, you've bought an ounce or 100 ounces or 1,000 ounces of silver. It literally takes, as I say, a couple of mouse clicks and the job's done. And it's reassuring, for people to know that the silver or gold that they've just bought is real. It's not digital silver or gold, and that's the end of it. It's been digitized so you can spend it, yeah, but it's physical and it's allocated and it's audited. There's a one-to-one relationship, and the independent auditors, of course, have produced their reports, and they're on the Kinesis website. So, whenever anyone says to me, well, I've not heard of Kinesis, can I trust them? Well, don't take my word for it. Go onto the Kinesis website, read all about the service, and read the audit report for yourself. It's like anything else. You do your own due diligence. You satisfy yourself that the company is what they say they are and who they say they are, and then you proceed from that point onwards. But for me, I always say, look, physical gold and silver is great, but if I stick it here in my house, and it's in my hand, people say if it's not in my hand, I don't own it, and all that kind of stuff. Well, I can see why people say that, and I can see why you might want to have some stashed away somewhere. But my personal view is that it's probably safer in a recognized bullion vault that's audited, and my physical is allocated. I kind of feel somewhat safer with it there than I do here in my house somewhere, which could quite easily be broken into and the stuff could be stolen.
And you get a yield. So it's just win-win-win.
But it's all about your attitude to risk, isn't it? And everybody has their own individual approach to risk and risk assessment. And that was part of my job as a meteorologist, is to assess risk. I was assessing risk on behalf of pilots. I was assessing risk on behalf of emergency responders in flooding situations and rescuing people, that kind of thing. So, it's all about risk assessment, and everybody has to do their own individual risk assessment and make their own personal decisions, because what's right for me might not be right for you, might be different for Patrick, and that's absolutely right and proper.
Just add on Kevin, look, it's like, we're not financial advisors, but you could have each. It's not everything and or. It's like you could have physical bullion, your coins, your stuff, your physical, because of course, like, that's good. But for the other stuff, to maximize all that physical that's just hanging in there that you can't go to Kitco, you can't trade it easily. Well, you just buy it on the platform and just do like Kevin showed, swap in and out. So that's why it's best, guys, to prepare ahead of time. Don't wait for us to tell you it's a signal and then the price is running up. Like people could already put money like in a bank. They don't wait to need to use the bank, right? People put their money, it's there. If ever they need it, they take it out. Same thing with Kinesis platform. People could just upload whatever they want. You could leave it in fiat. That's another thing, Kevin, I like. I could swap my fiat. So let's say I buy gold with my Canadian dollars, and I think Canadian dollars is going down. I could sell my gold and hold another currency. The Swiss franc is a great currency, which is like, for me, that's the best currency in the world other than gold. But in the fiat currencies, like the Swiss franc's number one. You could hold that. And so people have to prepare ahead of time. Hopefully, this reaches out and people are able to know that there's other tools right now at their disposition other than the classical tools of just holding the physical and silver, in their basement or underground where it's hard to swap, to increase your stack. And just for the ratio tracker we have, there's email notifications, guys. So even if you don't want to hassle, you don't want to log, you don't want to understand, you just want to get an email when we swap for gold for silver or gold for Bitcoin for gold, whatever it is, you just sign up for email notifications and you just wait for that email. And then if you want to get the detailed explanations, you go on the website and then, okay, that's why they swapped. That's the weight of evidence. Okay, let's do it.
That's really interesting. As a Canadian, do you trust your banking system?
Look, I got a big wake-up call with the trucker thing. You remember that? I don't know.
Yep, that's why I was asking.
Look, I don't want this can be recorded, but the first thing I went to do is I took out a chunk of cash and I'm keeping in the house, like just like, man, because remember, my father's Lebanese. I saw this happen in Lebanon where all the Lebanese people that had great interest rates. Before, it was like almost a Ponzi scheme. Before the system imploded, you could put your money in the bank for 8-10% interest rates. That's when the rates were at zero. And overnight, the bankers, they took their money out, they went to banks in Cyprus, whatever, and the whole rest of the population locked down. They can't even get $50 a week, or it's bonkers, while the Lebanese pound went downhill. Could this happen in Canada? Well, I wouldn't think so, but that trucker thing, seizing money and all that, it kind of, okay, Pat, I have a family. Now the probabilities, they've shown me something that is possible. So now the probabilities are shifting that my trust level did go down, seriously. So,
and also, to add to that, it's happening here in Europe as well. Turkey is a European country. I've just come back from vacation in Turkey. And it's very interesting talking to the people out there, the taxi drivers, the shop workers, and all the rest of it. And they just said to me, look, our paper is confetti, it's toilet paper, our money is toilet paper. And, they've got 50, 60, 70, 80% inflation. Life is very hard for them out there now. Even as a visiting tourist, the prices in the shops and in the restaurants and in the bars are probably a little bit more expensive than they are here in the UK. But you have to factor in that here in the UK, the average salary is, I don't know, in US dollars, it might be something like $50,000 is the average take-home salary per year. But out there in Turkey, the average take-home salary is closer to $5,000. So they're earning approximately 10% of what we are here in the UK. But the prices are very, very similar, which clearly makes it very, very unaffordable for your average Turkish person. Just pull up one chart of the gold price in Turkish lira, and you'll see exactly why it can make a huge amount of sense to have at least a portion of your wealth in physical gold, because in a situation like that where inflation begins to run away with itself, and even in modest inflationary times, those that, like we saw in the 1970s, for example, where inflation was 5, 10, 15%, gold acts like a lifeboat, doesn't it? And we all know that it helps to preserve your wealth, and we know that gold tracks loss of purchasing power. If that money was in the bank, of course, during that period in the 1970s, you'd have come out of it at the end with your fiat currency worth less than half of what it was when you went into that decade, probably about 30% of what it was. So, gold has a very, very important role to play in preserving and protecting your financial position. And if you play it right and you leverage that position, then you can actually increase your wealth as well through a number of other means, like using the ratio tracking chart that we've spoken about, like leveraging it with silver, because silver, of course, is more volatile and the percentage gains can be greater. And of course, if you're playing the stock market, you can play the miners at advantageous times as well, when the miners can outperform gold and silver for a period of time. So it's a case of having a full 360-degree awareness of what is going on in the world around you. And as you said a moment ago, Andrew, the inputs are constantly changing. The environment is constantly changing. We've just come out of an era of 40 years of decreasing interest rates and decreasing yields. The 10-year yield and the 30-year yield have broken out of a 40-year downtrend. That instantly tells us that the environment that we're in, the economic environment that we're in, is now different to what it has been for the last 40 years. It has more similarities with the 1960s and the 1970s, in fact, than it does with anything that occurred during the 1980s, 1990s, and the early 2000s.
That's an important input. And it's so often we look at all the crosses, and what you're saying is obviously all of these crosses interact with each other. And you've just described something. I mean, basically, we now view, obviously everything is a risk reward situation. Money in the bank, even in the UK, anywhere, it's a risk reward decision. So you are taking a risk putting that money in there. I mean, look what happened to the regional banks in America. Look at how suddenly that deposit base evaporated as people sought 5% rates in money market funds, draining liquidity out of these these banks that built America, that made America great. So it's interesting. You just mentioned. So you track this kind of stuff too.
Absolutely. And the fact that you mentioned the banks there is interesting as well, because particular charts like Bank of America, for example, do not look good right at this point in time. Bank of America has broken down in a technical chart in a very similar way to what it did back in 2007.
Wow.
We know what happened. We know what happened after that. So the technical chart for Bank of America and a number of other banks actually looks eerily similar to what was beginning to unfold back in 2007. So all of these things attract, and what you say about risk reward is absolutely critical. We never enter a trade without doing a risk reward calculation. We tend not to risk more than 2% of our net asset value in any one trade. So if that trade goes against us, 2% down on the NAV. And by using this confidence measuring technique, it means that we can weight our trades so that we take a 2% NAV risk on the trades that have high confidence, but maybe only a 0.5% or a 0.25% NAV risk on the trades which are a little bit more of a gamble. And that is what allows a portfolio to grow over time. If you're able to actually know beforehand which trades carry the greater likelihood of success, you can then weight your trading appropriately and watch your portfolio grow by doing that. So all of this analysis feeds in, but none of it works without risk and reward and sound risk and money management.
Absolutely. It's so interesting. So this is more reasons why. I mean, these crosses are so complex. I mean, who's got the time to do it? We need to be crazy like us. I'm crazy in the gold market, silver market. I live and breathe it. I'm that's called crazy. But you guys are so specialized. Other people probably think you're crazy, but by tapping into this wealth of specialized knowledge, nobody else is going to have all of this information. I think the two of you, it's interesting because the two of you sort of meet, these two sort of worlds meet and they complement each other. And I think this is tremendously interesting. I think people need this at this time because, as you say, there's so many changes. The inputs are changing. I'm mind blown at some of the changes that are going on. Look, you've got de-dollarization going on. The weaponization of the dollar has created a massive move. And we've come out of India just now. And what we're doing is we're going into August, the 24th, 25th. And we're very, very likely going to see a gold-backed currency. Almost certainly, we've got very close relationships with our Russian refiners who are definitely saying this is happening. So, these are inputs. So you need to be on top of, and you guys, what you're doing is you're saying, okay, let's see where those positions are. And then you can then make a decision as to, do I want in? Do I want out? And as you say, risk reward, you need to then determine. And I think this is where you come in very, very powerfully. It's fine to have a core position. No one's going to take my bullion. I don't care what happens to the price. Up or down doesn't matter. But when we do a trade, I often think the best thing to do, and I always say to people who I work with, write out the check as if you've lost it. All right. So that's the amount you can not possibly lose more than. You've already put it, take that check and throw it away. Now you can think clearly. And if it goes wrong, it's already gone. So you've lost nothing and you're on to the next thing. And it's an interesting situation when you've got when you've got this much input and you just say, you get a text to say, hey, maybe this trade I was waiting for is coming. So you can elect to have these texts, can you?
Yes. You summed everything up. The crosses, it's intermarket analysis. That's all we do with the charts. Remove the noise, remove the FOMO. How many times people have been trapped by FOMO? We get DMs from people, Patrick, man, I wish I would have seen your chart before. I bought Bitcoin at 55,000 in 2021. It's rocketing upwards. Look, there's no reason to fall for FOMO. Take your time, guys. And again, people ask me, am I bullish or bearish on something? But like you said, Andy, no position is a position. Even if let's say Nvidia is rallying to the moon, I'm not going to chase that volatility. We're going to wait, let that volatility run out, let it contract, coil, then we might enter. It's crazy how we've removed totally the emotion from the equation by stripping all the noise, just looking at the charts and having confidence that that's look, and Kevin didn't mention it, but we have a performance dashboard. Like people could go and see like the results of this. So even if one trade out of two is right, because we always use favorable risk versus reward on the net, we're positive, like nonstop. So look, that's what we dream. You're right. Like I wake up, I have an idea in the morning. Kevin, did you chart this relationship, those two? And then we get on a call and we start talking about it. And that's the value. Like we're doing the hard work and we're presenting that through our website.
Yeah, all of the. I would hate to sit here and just sort of come across as someone who's trying to advertise a service that may or may not work. I mean, as I said at the start, I'm a scientist and I demand evidence, I demand proof. So it's quite right that on the website that we have, all of that proof and evidence is there. So what Patrick mentioned there, the performance dashboard, it's our tool that allows people to see what our actual trading results are. It's all there for people to look at, and also when people join the website, it's there in a lot of detail as well. So we don't hide any of that. All of our trades are entered in a what we call the trade tracker, the entry price, the exit price, the profit limit, the sell stop, and then when we exit, it's recorded. The profit or loss is recorded. All of that stuff is there, all of the evidence, and we explain all the way through what the risk is, what the reward is, what the overall NAV position is. I mean, as it stands at the moment with all of our trades, if every single one of them goes against us, our NAV is still way in the positive because of the accumulated successes and gains that we've had over time. So it's a nice position to be in, knowing that no matter what happens, you're never going to be in a worse position than you started off at. So that's great to know, but that's of course not the aim. That's not the goal. The goal is to carry on building the NAV and building the gains at the same sort of rate. And key to it, of course, is to outpace inflation. You know, inflation might be 10%, so you've got to beat that to even factor in a gain. You know, you can't just use nominal values. You want to be beating inflation by being involved in the trades that are making the biggest gains at that point in time. And sometimes, you know, you look at a trade and you'll be pretty confident that something is going to move to the upside. But when you do the risk reward analysis, it just isn't quite good enough to justify taking that trade. You might get a 2-to-1 or a 2.5-to-1 risk to reward. Well, you know, okay, that might involve a 50% move to the upside, but even a 50% move to the upside is not necessarily good enough to get into that trade. And this is where the whole risk reward money management protocols come into it, and the education that we do on the website to try and get people away from thinking about whether a stock is going to move 100% or not. That doesn't matter. It doesn't move if it moves. It matters if it moves 200%, because unless you put your entire wealth into that stock, you're not going to gain 200% on where you started. So it's all a question of how much do I put into that trade and how much risk am I prepared to accept. That's the risk reward analysis in a nutshell. If it goes against you, how much of your NAV have you lost? So at the point you enter the trade, you need to know how much you stand to lose, as well as how much you stand to potentially gain. And that's your risk reward. And only by knowing that can you go into a trade with your eyes open with all of the facts. And that's, you know, as a scientist, that's what I kind of, and myself and Patrick work very carefully and closely together to be very clear to our members and to our subscribers and anybody that asks. Just, we're completely transparent. You know, there's nothing to hide. It's all there. It's all laid out. Our techniques and methods. We don't hide any of our methodology. There's a very clear weight of evidence process that we go through. And the more people understand it, the better from our point of view. We want everyone to understand it. And if people just want to play the trade and not get bogged down in trying to work it all out, then that's fine as well.
Yeah, no, that's fantastic. I'm just, excuse the noise here. The gardener's just started up a lawnmower.
I thought I could hear something. I wasn't sure. I thought it might be your brain thinking.
Well, it could be sometimes, I think. Ask my wife, she might think so. But no, this is interesting because so there isn't much you don't cover. I mean, really, basically, when you're looking at one, so, you know, you can't just look at one thing. You have to look at all of these inputs. So I think, so really, what don't you cover? I mean, it's pretty much you cover everything.
Nothing. There's nothing. Any investment, anything, stock markets, precious metals, commodities, energy. You know, anything you can think of. Big, cryptocurrencies. We cover cryptocurrencies, of course. Bitcoin miners, crypto miners, anything that's investable, ETFs. If it's a chart that meets our criteria and fits the bill, and I suppose it does help if it's liquid, if there's enough of a market cap to enough trading around that stock or share. There's a whole load of factors that we think about. Is there a dividend payout, for example? Is it going to be good for people's retirement portfolios? Are they called 401ks or something like that in the United States? So there's a whole range of factors that we consider. Micro cap stocks can be exciting, but they can be very illiquid and difficult to get out at the price you want to get out at, and all that kind of thing. So we're aware of the limiting factors around the markets. But to answer your question, there's nothing that we don't cover. It's just that we don't necessarily take positions in things that don't meet our criteria.
I'll tell you why we cover everything, because we do a forest to tree approach, Andy, because we understand the macro capital flows. So those major asset classes, is it value or growth, right? Is it SPX and NASDAQ, or is it gold, oil, silver? Because right away we're able to compare those two, then we go down the pyramid, and then, okay, let's say gold's outperforming SPX. Then we'll look in the gold, okay, is silver, the miners outperforming? Is it the big cap, the small stocks, caps outperforming? And going down, trickling down, we know that the guy at the bottom has the tailwinds protected by big daddy gold. Or for long growth stocks, then it'll be inverse, right? If you're starting to play these beta plays or these leverage plays on the SPX or NASDAQ, let's say Bitcoin, well, you're only going to go long these instruments if big daddy SPX is outperforming its gold, right? So because we're doing first to a tree,
it's like a health check. I could look at somebody. I could look at Patrick, and when he's not feeling very well, and I could say, Patrick, you've got the flu. I might be right, I might be wrong. I know he's not well, but I've made a diagnosis based on one thing, and that is what he looks like. What I don't know is that he's got an infection, he's got sepsis, and if he doesn't get treatment and antibiotics, he's going to die next week. And that's exactly the thought process that we apply to technical analysis. You have to not just look at the chart, not just look at one element of it. You have to do a full health check, and the full health check involves all of the weight of evidence that Patrick just described, and a whole load of other stuff as well. It's like a doctor examining a patient, basically, and then you can come up with a diagnosis that at least has a good chance of being the correct diagnosis. And that's probably the best way I can describe it.
Well, maybe you should go into medicine, because when I went to I go to the doctors now, they just Google. They Google. Hang on, are you just Googling what I just asked you about? Yes, I are. So, okay.
Remind me not to go to your doctors.
No. Well, luckily I don't need them. But occasionally you go down there and...
yeah, I know what you mean. Yeah,
Lord, protect us.
Yeah, I'm afraid. Well, you find that kind of approach all over the place these days, because the internet is the font of all knowledge, and it's assumed that you can just Google it and get the correct answer. But you have to put in the hours, you have to put in the work, you have to do the research. And I'm personally drawing on my background in meteorology, Patrick in his background as an IT specialist and Linux engineer, and all his analytical skills and abilities there as well. So we're both joining forces to bring out to the maximum what we've learned over the decades, really, and just trying to share that with our followers and subscribers. It's a tricky process to try and explain. It's not easy to teach. A lot of it comes from, as you know, Andy, a lot of what comes in, it's a case of your own experience, your own knowledge, your own background. You have to put in the hard work. It's not just something that someone can teach you in half an hour. And you have to put in your time at the coalface, really, don't you?
Well, I think thank you so much for spending some time with us today. We really must circle back, and I mean quite soon. And so people can access you. Obviously, we're going to put the link. So this is a deal. You're offering a deal to Kinesis subscribers. If you could just re-outline that deal so that people know what they're getting.
It's super simple, Andy. It's they use a discount code Kinesis, and they get 50% off lifetime. They'll never pay more, even if we raise our prices later because of inflation. You've locked in that price forever, 50% discount. So use a discount code Kinesis. Subscribe to Kinesis. People should put some fiat in Kinesis, and so they'll be able to leverage our ratio tracker, right, eventually when we give signals. And hopefully that gives enough value so people could actually increase their wealth, protect their purchasing power, and end up for the better, right?
Yeah, I mean, we're there to help our members as much as we can. We always answer questions. We always get involved in the conversations that are taking place in the chat sections of our website as well, and the comments that follow from our charts and our podcasts. So, we're there to help. We're there to educate. And as Patrick just said, 50% discount and no price increase ever. Once you've joined, you can renew monthly or annually, and not ever have any increase in your price plan.
Sounds brilliant. And honestly, thank you for spending that time with us today and sharing your knowledge. It's all about education. That's really all we're about as well on our Live from the Vaults, is about bringing information to people so they can make better choices. And I think, that's what I see here. And I think, whether you're a trader, stacker, make one trade a year, I mean, it doesn't matter. I think it could pay for itself in just one trade. So thank you so much, guys. Kevin, Patrick, different sides of the world. And but thank you.
Yeah, appreciate it, Andy. Thanks.
It was an honor, Andy. Thanks for having us.
Thank you.
All right. Thank you, Andrew Maguire. And thank you so much, Kevin Wadsworth and Patrick Karim of Northstar Badcharts, for that amazing offer to all of our Kinesis and our Live from the Vault community as well. Thank you so much. That's a 50% off. That's amazing. And again, thank you so much for a fascinating discussion here. And remember, to everyone in our community, buy physical, make sure it's 1-to-1. Understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. Buy physical. And there you have it. That's all we have for you today on another episode of Live from the Vault right here down in southern Italy. So please help keep spreading the word about this channel by hitting that like button, sharing the information, and subscribe. Click on the bell. You know the deal if you want to be notified in real time as each episode goes live. And with that, we will see you next time right here on Live from the Vault. See you then.